Today, something happened in the silver market that most people will not fully understand until much later, but the numbers are already on the table and they are not subtle. Before we go any further, understand this clearly. What unfolded in Shanghai is not just another overnight fluctuation, not just volatility, not just traders pushing buttons. It is a structural signal, and when structure starts shifting beneath price, the ones who are paying attention early are the only ones who have time to think clearly before the crowd reacts. So let's walk through this carefully and without exaggeration, because the data is already strong enough on its own. Shanghai silver futures opened at $99. That is the opening print. Western spot going into that same open was sitting at $88.50. That difference did not come out of nowhere. In the previous discussion, we talked about the physical demand signal coming from Shenzhen recyclers, with bids running $5 or more above the Shanghai Futures Exchange pre-holiday close. That was not random noise. That was not speculative chatter. That was the physical market quietly pricing silver before the exchange even turned its screens back on. And when the exchange opened, it confirmed what the physical market had already been signaling. After opening at 99, Shanghai pushed all the way to $102 per ounce before eventually closing the session at 96. Now here is an important detail that needs to be understood properly. The session average printed at 96. However, the final physical lot reportedly cleared at 102. Whether someone chooses to focus on the session average or the final clearing transaction is a fair debate, but both numbers sit decisively above Western spot pricing. That is what matters. At the moment, Western spot is trading at $86, which means Shanghai closed with roughly a $10 premium over Western pricing. $10. That is not insignificant. And during the entire Shanghai session, Western volume was relatively quiet. Volume remained low while Shanghai was trading at a heavy premium and physical bids were running well above paper pricing levels. That kind of disconnect does not happen by accident. It is not a coincidence. It is structural. When physical bids exceed paper pricing by that magnitude and volume does not respond proportionally, it suggests that the pricing mechanism between East and West is not aligned. And when mechanisms fall out of alignment, something eventually forces reconciliation. For those who focus strictly on short-term price movement, understand that this is educational analysis, not a signal and not advice. The objective here is to read structure in real time, not to predict an exact candle. In recent analysis, one key resistance zone was outlined between $87.20 and $89. Price has now rejected that zone 3 separate times. Each rejection has occurred without a decisive, displaced hourly body close above that resistance. Wicks have tested, but bodies have not closed with authority above 89. That distinction matters. Price is currently sitting at 86.40 on Western spot, which places it back below that resistance range. 3 rejections from the same zone without a clean break tells you the level is still functioning as resistance until proven otherwise. A wick is not confirmation. A body close above 89 is confirmation. That is how tape structure is read properly. Now widen the lens slightly because the options market is sending its own message. The Comex implied volatility index for silver options is now sitting at 134. Previously, when this was discussed, the index had only just broken above 100. It is now at 134, exceeding levels seen during the spike when silver reached $120 earlier. That is not a normal reading. That is the options market pricing in the possibility of violent, potentially disorderly movement that the current spot price does not appear to reflect yet. Both the SLV volatility index and the silver futures implied volatility are pointing in the same direction. They are not pricing calm. They are pricing sharp upside risk. Meanwhile, the price itself remains suppressed below resistance. When price compression exists alongside expanding volatility expectations, those two conditions rarely coexist for extended periods. At the same time, the Shanghai Futures Exchange took direct action today. Another group of accounts was suspended for breaching trading rules. That brings the total number of suspended accounts this month alone to 23. There were visible manipulation attempts at the Shanghai Open, documented in real time by individuals tracking order flow. The exchange responded by suspending the accounts involved. This is not rumor. This is not speculation. The exchange confirmed that activity was severe enough to warrant enforcement action. 23 suspensions in a single month is not routine. Now shift to settlement pressure because this is where the leverage is most concentrated. March open interest stands at 37,651 contracts. That represents 188 million ounces of paper silver moving toward settlement in 3 trading days. Registered Comex silver, the category that is warrant issued and available for delivery, sits at 88 million ounces. That is approximately a 2-to-1 ratio. 2 ounces of paper claims for every 1 ounce of deliverable metal. The roll into May has begun, and May open interest has increased as longs migrate out of March. However, the migration pace has not been sufficient to eliminate delivery pressure entirely. Today the clock continues moving. The final safe opportunity to roll March futures positions before delivery risk increases is approaching rapidly. Once first notice procedures begin, shorts may issue delivery notices and any remaining long positions face assignment risk. There is no ambiguity about that process. What is also notable is that registered silver inventory has remained essentially flat to slightly lower in recent sessions. No meaningful influx of fresh metal has entered Comex vaults to replenish registered stocks. That matters because paper claims are moving towards settlement while deliverable inventory is not expanding. Another structural signal worth watching closely is the carry-adjusted basis between March and May futures. In normal market conditions, futures contracts further out in time trade at a premium to spot, reflecting storage and financing costs. That is contango. When nearby contracts begin trading at a premium to future contracts, the structure shifts into backwardation. Backwardation in a physical commodity market communicates urgency for immediate delivery. It signals that holders value present possession over future promise. The market has not yet confirmed a backwardation flip, but the spread is being monitored closely. If that inversion occurs, it alters the conversation meaningfully. Physical stress in commodity markets becomes visible when the paper structure managing price perception begins to show strain. That is not theory. That is observable when one exchange closes at 96 while another trades at 86. The divergence is measurable. Whether it resolves upward or downward remains the open question, but divergence of that magnitude does not persist indefinitely without consequence. The structural tension is present, and when tension builds inside financial systems, release eventually follows. Today, the focus remains on the numbers because the numbers are what separate noise from structure. When one exchange closes at $96 with a reported final physical lot clearing at $102, while Western spot trades at $86.40 beneath a resistance zone, it has now failed to break 3 times. That divergence cannot simply be dismissed as routine volatility. The gap itself becomes information. A $10 premium between Shanghai and Western pricing is not theoretical. It is measurable. And when physical bids in one region consistently exceed paper pricing in another, the mechanism that normally keeps those two aligned begins to look strained. Now zoom out and layer in the geopolitical backdrop, because commodity markets do not operate in isolation. Crude oil moved to $67, marking the highest level seen since late summer. Positioning in oil has turned increasingly bullish. The question circulating quietly in commodity circles is whether capital is moving ahead of potential escalation risk tied to Iran. At the same time, global oil discoveries have declined significantly over the past decade. Average annual discoveries fell from roughly 10 billion barrels during the earlier half of the decade to approximately 6 billion barrels in the later half. That 40% decline is not cyclical volatility. It is structural underinvestment. And when new exploration declines, the lag between discovery and production means supply constraints can persist for many years. When oil rises due to both geopolitical risk and long-term supply contraction simultaneously, it injects inflationary pressure into the broader macro environment. Inflationary inputs feed directly into precious metals positioning. Gold and silver do not move in isolation. They respond to currency confidence, energy inputs, sovereign positioning, and capital flows. And right now, the signals are not subtle. India just recorded another record month for gold imports. That is not an isolated data point. It is part of a consistent, sustained pattern of elevated Eastern physical demand. The narrative presented in much of Western financial media still attempts to frame gold's rise as speculative enthusiasm or short-term momentum. But spot gold trading at $5,130 is not explained by vague momentum alone. Institutions and sovereign entities in Asia are making deliberate allocation decisions. They are not reacting emotionally. They are reallocating capital based on judgments about currency stability, geopolitical risk, and long-term purchasing power. Anyone who verifies World Gold Council data, Indian import records, or Chinese exchange-traded fund flows can see the pattern clearly. Physical demand has been elevated for months. Meanwhile, Western narratives continue searching for explanations that fit older frameworks, often missing the structural shift taking place beneath the surface. Now return to silver because the cautionary side of the analysis matters just as much as the structural argument. The Shanghai session offered an important lesson. Silver opened at 99, surged to 102, and ultimately closed at 96. It did not hold the 100 level. That tells you something critical. There is real selling pressure above 100. Not everything above that level is artificial suppression. There are genuine participants willing to reduce exposure or take profit at triple-digit pricing. That matters because markets are two-sided. Ignoring real selling pressure leads to distorted expectations. The implied volatility reading at 134 reinforces that dual risk. Elevated implied volatility does not guarantee upside resolution. It simply confirms that options markets are pricing large potential movement. That movement can occur in either direction. A coordinated intervention, a cascading margin call event, or a broader risk-off liquidation across asset classes could produce sharp downside volatility just as easily as upside acceleration. The volatility index reflects magnitude, not direction. At the same time, Western spot sitting at 86, while Shanghai closes at 96, does not automatically guarantee Western prices rise to close the gap. It is possible for Shanghai to retrace downward if physical demand signals weaken or if speculative flows reverse. Divergence resolves, but resolution does not always occur in the direction many expect. That is why disciplined analysis must consider both structural tension and immediate tape behavior simultaneously. Now examine settlement pressure again, because this is where leverage compresses into a narrow window. March open interest at 37,651 contracts represents 188 million ounces of paper silver approaching settlement within days. Deliverable registered inventory sits near 88 million ounces. Approximately 2 ounces of paper exist for every 1 ounce of deliverable metal. The roll into May has reduced some March exposure, but not enough to eliminate assignment risk entirely. As first notice procedures approach, any remaining long positions face potential delivery assignment, if not rolled or closed. Critically, registered inventory has not expanded meaningfully. No large inflow of new metal has replenished vault stocks. When open interest remains elevated relative to deliverable supply and no new metal enters the system, the pressure concentrates. That does not guarantee default or crisis, but it does elevate sensitivity. Markets become reactive when leverage ratios compress into tight settlement windows. Another structural component remains the carry-adjusted basis between March and May futures. In contango structure, distant contracts trade at a premium due to storage and financing costs. In backwardation, near-term contracts trade at a premium to later ones, signaling urgency for immediate delivery. The market has not confirmed backwardation yet, but the spread is tightening. If March were to trade at a premium to May on a sustained basis, that would indicate immediate demand outweighs future supply expectations. In physical commodity markets, backwardation communicates urgency far more clearly than headlines ever could. Now integrate the volatility reading with the basis structure and the exchange suspensions. 23 account suspensions in a single month at the Shanghai Futures Exchange confirm that manipulation attempts were significant enough to trigger enforcement. Visible order flow irregularities were documented in real time. The exchange acknowledged rule breaches and acted. That confirmation adds weight to the structural narrative because it demonstrates that pressure exists at the exchange level, not just in commentary. When volatility expectations surge, settlement leverage tightens, physical premiums widen, and exchange enforcement actions increase within the same window, the pattern becomes harder to dismiss as coincidence. Yet discipline requires acknowledging that price remains below Western resistance at 89. 3 rejections remain intact. No decisive hourly body close has displaced that level. Structure at resistance is still functioning. Until that level breaks with conviction, short-term tape readers must treat 89 as active resistance. At the macro level, oil at $67 adds inflationary pressure. Gold imports in India confirm Eastern accumulation. Gold trading above 5,130 signals sustained demand for hard assets. Meanwhile, silver remains below Western resistance despite elevated volatility and physical premiums in Shanghai. That divergence between gold strength and silver compression introduces another layer of complexity. Silver often lags before accelerating, but lag is not timing. The data right now is layered. Shanghai closes at 96. Western spot trades at 86.40. The premium stands near $10. The final physical lot reportedly cleared at 102. Comex implied volatility reads 134, the highest since the earlier spike. 188 million ounces approach settlement against 88 million ounces of registered supply. Oil trades near multi-month highs. Eastern gold imports remain strong. The basis spread approaches potential inversion. Resistance at 89 remains intact. Each of these components alone might be manageable. Combined, they create structural tension. Markets can tolerate tension for a period of time, but not indefinitely. Resolution eventually occurs through price, inventory adjustment, volatility collapse, or sudden expansion. The only unknown variable is timing. And timing is dictated by liquidity, positioning, and participant behavior, not commentary. So the honest framework remains this. Watch the resistance level. Watch the basis spread. Watch registered inventory flows. Watch implied volatility. Watch settlement migration pace. Watch physical premiums. When multiple indicators align in the same direction, probability strengthens. When they conflict, caution increases. The current environment contains both structural stress and immediate resistance discipline. Today, the market stands at a point where two narratives are unfolding simultaneously, and they are not telling the same story. On one side, the paper price in the West is sitting at $86.40, below a resistance zone that has rejected price 3 separate times between $87.20 and $89. On the other side, Shanghai has just closed at $96 after opening at $99 and pushing as high as $102, with the final physical lot reportedly clearing at $102. That is a measurable divergence of roughly $10. And when divergence persists between physical pricing and paper pricing, the question is never whether it exists. The question is how and when it resolves. The structural pressure begins with settlement. March open interest remains at 37,651 contracts. That equals 188 million ounces of paper silver heading into settlement within 3 trading days. Registered Comex silver, the warrant-issued category eligible for delivery, sits near 88 million ounces. That creates approximately a 2-to-1 ratio of paper claims to deliverable metal. The roll into May has reduced some exposure, and May open interest has risen accordingly, but the shift has not eliminated delivery risk. As first notice procedures begin, shorts may issue delivery notices, and any remaining longs who have not rolled positions face assignment exposure. There is no ambiguity about how that process works. The timeline is mechanical. What is equally important is what has not happened. Registered inventory has not meaningfully increased. No significant inflow of fresh metal has replenished Comex vaults in recent sessions. While paper exposure approaches settlement, the physical cushion beneath it has not expanded. That does not automatically signal crisis, but it elevates sensitivity. When leverage compresses against limited inventory, the system becomes less tolerant of sudden demand shocks. Now incorporate the carry-adjusted basis between March and May futures. In standard contango structure, later-dated contracts trade at a premium to nearby contracts, reflecting storage and financing costs. That is normal market function. When nearby contracts begin trading at a premium to later contracts, that structure flips into backwardation. Backwardation in a physical commodity market communicates urgency. It signals that holders value present delivery more than future promises. The market has not confirmed a sustained backwardation yet, but the spread is being monitored closely. If March trades at a premium to May in a durable way, it changes the structural interpretation entirely. It would signal that immediate possession is being valued over deferred supply. Now return to implied volatility because it provides insight into expectations. Comex silver options implied volatility is reading 134. That is beyond the highs seen during the earlier spike when silver reached $120. Options markets are pricing the potential for violent, disorderly movement, yet the spot price remains compressed beneath resistance. Those two conditions do not remain aligned forever. Either volatility expectations compress downward or price expands upward or downward to meet those expectations. The longer price remains suppressed while volatility remains elevated, the more unstable the equilibrium becomes. At the same time, caution must remain active. Shanghai's session demonstrated that triple-digit silver is not automatically stable territory. The market opened at 99, surged to 102, and settled at 96. That indicates real selling pressure above 100. There are genuine participants willing to take profit or reduce exposure at those levels. The volatility index at 134 confirms magnitude risk in both directions. Upside acceleration is possible, so is sharp downside repricing if liquidity tightens or coordinated selling pressure emerges. Volatility measures range, not bias. Zoom further outward to the macro environment. Crude oil is trading at $67, the highest level in months. Positioning in oil has turned increasingly bullish. Global oil discoveries have declined approximately 40% over the past decade, from roughly 10 billion barrels per year earlier to around 6 billion barrels per year more recently. That structural underinvestment carries long-term supply implications because exploration lag can stretch 2 decades before production begins. When oil prices rise due to geopolitical risk and structural supply constraints simultaneously, inflationary pressure increases across the macro system. Precious metals respond to that pressure over time. India has recorded another record month for gold imports. That is part of a sustained pattern of Eastern physical demand. Spot gold trading at $5,130 reflects capital flows that extend beyond speculative momentum. Institutions and sovereign buyers in Asia are allocating deliberately. They are responding to currency concerns, geopolitical risk, and long-term purchasing power preservation. Anyone reviewing World Gold Council data, Indian import statistics, or Chinese ETF flows can observe the consistency. Meanwhile, much of Western financial commentary still searches for explanations rooted in momentum or bubble narratives. The divergence between narrative and data remains clear. Overlay that macro backdrop onto silver's current structure. Gold trades at elevated levels with confirmed Eastern accumulation. Oil trades at multi-month highs amid supply constraints. Silver volatility readings are elevated beyond earlier spike levels. Settlement leverage remains tight relative to deliverable inventory. Shanghai physical premiums exceed Western pricing by roughly $10. The Shanghai Futures Exchange has suspended 23 accounts in a single month for trading rule breaches, confirming manipulation attempts were material enough to warrant enforcement. Western spot remains below 89 resistance with 3 failed break attempts. That is the complete structural map. Each component alone may not dictate outcome. Combined, they form a tension field. The paper price and the physical market are not aligned. They have not been aligned for weeks. At some point, that gap resolves. The resolution could occur through Western spot rising to close the premium. It could occur through Shanghai retracing downward if physical demand weakens. It could occur through inventory inflows stabilizing settlement pressure. Or it could occur through a volatility expansion event that forces rapid repricing in either direction. What is not open to interpretation is the data itself. Shanghai closed at 96. The final physical lot reportedly cleared at 102. Western spot trades at 86.40 beneath a resistance zone rejected 3 times. Comex implied volatility reads 134. 188 million ounces of paper approach settlement against 88 million ounces of registered supply. No meaningful new metal has entered vaults. Oil trades at 67 amid declining discovery rates. India prints record gold imports. The basis spread approaches potential inversion. 23 trading accounts were suspended for rule breaches. The structural pressure points are visible. The timeline remains market-driven. The discipline required now is clarity. Separate what the data is saying from what emotion wants it to say. Elevated volatility does not guarantee upside. Physical premiums do not guarantee immediate repricing. Resistance remains resistance until broken. Settlement leverage remains sensitive until reduced. Markets resolve divergence on their own schedule. This is financial structure analysis, not advice. Protect capital, manage exposure. Watch the levels that matter. Monitor inventory flows. Track the basis spread. Observe volatility compression or expansion. The ones who survive volatile markets are not the loudest. They are the ones who read clearly, remain disciplined, and adjust when structure shifts. When the dust eventually settles, it will not be opinion that determined outcome. It will be who respected the data and who ignored it.